Hello, this is the next installment of our feature from Advanced Projections called News versus Noise. We've had a few things been going on in the past couple of months, and we thought we'd bring you up to date so that you would understand what's happening in the economy and in the markets. So here's noise from the third quarter, which ended very early this week. Remember, when you hear it in the popular media, it's already just part of the noise. So the noise is inflation. The worst may be behind us yet. Well, not really. There's still a long way to go and a lot of the battle to be fought. Unemployment does stay near record lows at 3.7%, much lower than previously expected. But the real news is what that tells us looking forward to additional Fed monetary policy moves. High gas and energy prices, which way will they go this winter? Well, gas and natural gas and electricity prices are all over the map. Fortunately, oil has stayed down below $100, but they may head back in that direction with the latest production cuts by OPEC+. Stock markets entered bear territory from January through mid-June and have continued their downtrends. There's been a couple of bear market rallies, but what's likely to come next and why? There's the usual majority of financial advisors still saying, stay the course, hang in there. The markets always come back, buy the dips. Well, the news is why that's still a bad idea in this particular case. Finally, just talks about discussions about recession. Are we in one? Are we headed for one? Most of the sources are soft pedaling the chances, but from our perspective, we're just about there. So, in the real news, here's what you should be paying attention to. First of all, the effects of the pandemic upon the domestic economy are pretty much in the rearview mirror, aside from significant labor shortages and residual but declining supply chain issues. The latest employment expansions recorded up through October show unemployment remains well under 4% at 3.7%. The bad side of that particular figure is low unemployment gives the Fed the green light for further rate hikes. They're trying to get inflation down, and as long as employment hasn't cracked yet, they see that that's an opportunity to continue raising rates in order to slay the inflation dragon. Now, exploding energy prices cracked with the Fed's 75-point June rate hike. They dropped immediately, literally within 48 hours, from highs of $123 a barrel back down to current territory. So this action in energy prices, if it continues, will reflect concerns about upcoming recession and retreating demand for oil. But the production cuts that I mentioned from OPEC+, which is the OPEC nations plus Russia, they will probably try to continue to support prices because, of course, it's in their best interest, not anyone else's. As of this publication date, oil is down about 25% from the second quarter price peak of $123 a barrel. Now it's up a bump today. It's a little over $90. Trading still hasn't finished on Friday the 4th, but we were below $90 for several weeks before that. Now, oil and petroleum products are very sensitive to small changes in supply and demand. A few percent undersupply causes prices to spike, and a few percent oversupply causes prices to collapse. It really doesn't take much. So these production cuts by OPEC Plus can have a significant effect on world oil balances, supply and demand balances, because they represent about 2% of daily production. So OPEC and Russia have renewed that 2-year-long production cut that was in effect up through April of this year, and it could stabilize oil around the $85 to $90 region for several months. But further production cuts may be coming as global demand softens. So here's the two main things you should be paying attention to. First, the Federal Reserve has continued to uphold their reasons for proceeding with their clearly scripted plan, while emphasizing their awareness of the economic pains to come from rising rates. They are going to continue to unwind their balance sheet and continue to raise interest rates for the remainder of this year and in 2023, probably deep into 2023. And they're not likely to cease these programs until 2024 or 25. So their turning point, full employment means employment at or below 4%, with the last low pre-pandemic at 3.5% in late 2019. The last several employment reports have been at 3.7% or below, including October's figure, which was again released this morning. The November and upcoming December Federal Reserve Open Market Committee meetings contain the next rate increases and affirmed solid guidance about ongoing steps to manage inflation and the health of the economy, as we have been predicting throughout this entire year. Every FOMC meeting since March of this year has confirmed this stance and has included aggressive interest rate increases. The M2 money supply is shrinking as the Fed unwinds its balance sheet, which pulls liquidity out of the markets. So we at Advanced Projections believe the Fed will monitor the effects of foreign adventurism by Russia and this other nonsense that they're carrying out with oil, but the Fed will continue to proceed firmly and aggressively to rein in inflation over the next 18 months. Really what they're looking for is employment figures to start cracking, and there's no sign of that yet. Job openings are still well above the number of available workers in the labor force, and new jobs are still being generated to the tune of hundreds of thousands per month. So as far as the Fed is concerned, that's hunky-dory with them. Now, the market super bubble we've been talking about had already begun to collapse in the first quarter of this year. We put out an extreme equity risk warning back in early February, and this collapse, when combined with inflation, will push us into recession relatively soon. The equity collapse is now preceding the onset of the recession, just as we predicted about 6 months ago. The main thing here is all 6 of our recession indicators are hovering in or nearly in red, meaning it's a 90+% chance probability that we're already in the recession. But you're not going to hear about it until the NBER makes a declaration months from now. So leading indicators, one of our 6 that we utilize, this basket of leading indicators, there's a basket from the Conference Board, which is a private, we'll say wealth advisory company. And then there's the Federal Reserve and the OECD, which has their own basket, and both are pointing in the same direction. And that direction is down. This is what the Conference Board shows as when their leading indicators move into risk territory, warning signal, and then once it goes below that particular level, recession is essentially guaranteed. So you see back here in 2001, when their LEIs went below this level, recession came within a half a year. Here, just ahead of the Great Recession, it happened within 3 or 4 months. And here, just ahead of the COVID recession, which we were predicting a recession before COVID even showed up on the scene. And part of the reason we were predicting that is because of this behavior of leading indicators. And that came very rapidly, very sharply. So you see, these slopes are steep, but not nearly as steep as what's going on here. So this, in our interpretation, means you're going to see a gray bar starting around this area when the announcement is finally made about the onset of the recession by the NBER. These folks are academics. They will not make a real-time declaration, but we do. So the misconception, of course, again, from the majority of financial advisors is that the new equities market declines won't go much deeper or be very prolonged. So just hang in there and let them evaporate your money for you. Equities continue to be overvalued in the aggregate. That's the fact. Third quarter earnings and fourth quarter earnings warnings will show cracks forming in the walls of the equities markets. In fact, in the third quarter, if you strip energy out of the S&P 500, earnings have begun to decline, and that is also a harbinger of recession. So bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The euphoria was back here at the end of 2021. That's when we started saying it's time to get out. Our extreme risk showed up in January and February. We announced it in February. And since then, the markets have declined substantially. The S&P is down over 20% from our warning and over 25% from its peak at the beginning of the year. So our claim is, of course, the euphoria is over. Super bubble created by massive federal economic COVID interventions will now continue to deflate over many more months, perhaps longer. Rising interest rates, energy prices, and foreign adventurism will create the necessary fear and uncertainty that keeps feeding this kind of decline in the markets. It has already reached lows in excess of minus 25% and must inevitably cycle through this whole range of bear market emotions, which finally ends in depression and capitulation selling from people that are just, bemoaning the fact that they've lost 40, 50, 60% of their nest eggs, their 401ks, or their investment portfolios. We're trying to help you avoid that kind of financial loss and loss of peace for your own, mental well-being. To finish up here, we just have this little quote from one of our fans, shall we say, a subscriber, that said this for us, or about us. Before I found advanced projections, I was searching for a reliable source of macroeconomic data that could give me an organized, condensed, clear, and current direction of the overall U.S. economy. Advanced projections is exactly what I was looking for. It gives me peace of mind in the final decisions I make regarding long-term investments and business decisions as well. So thanks, David, and we hope that you will enjoy and learn from this video. Give us a thumbs up and do these other steps for us as well, especially this part. Leave a comment with your thoughts and questions.